The first principle speaks to a one-step measure. In theory, very simple. You can decide to start implementing it now. All it takes is one line on the chart, and it will keep you out of many bad trades, real trench trades. Is not longing under a short level or shorting above a long level. I'll give an example of this in the second slide. Scenario casting is something really only top traders do, and when it's done correctly can be a real game changer. This is where most traders lose money and where confirmation bias plays a much bigger role than most believe. We're going to go deep on this. And lastly, you can be in before everyone else if you wait for this moment. This simple schematic illustrates the first principle. When you have a bearish structure like this, where price is still under the last break, which is a bearish break, longs are very low probability. And it's how most traders lose money. If price reclaims the bearish level as it's holding above a short level, longs are possible, but still higher risk and lower probability. Because at this point, near this level, probabilistically speaking, downside continuation is more likely. But if price puts in an upside break and is now above a long level, probability shifts immensely. Of course, we don't enter immediately as probability shifts, but we wait for the trend origin point trigger, which are two subsequent breaks. I've gone through these in previous videos and the possible scenarios we can expect around trend origin point. But yes, probability shifts once we are above a long level. The simple rule gives a mechanical way to guesstimate probability, and if implemented, will keep you out of the worst trades. I mentioned in the introduction that when scenario casting is done correctly, it's a real game changer. I have to emphasize the done correctly part, because you often see a trader scenario casting still distraught with his own bias. Technically speaking, there's only 4 scenarios you need to consider in any market. Based on if the last break was bullish or bearish, 3 scenarios should be cast to how the market will continue in the direction of the last break, and 1 scenario casting a complete reversal. The scenarios are overweight continuation 3-1 because reversals happen much less often, statistically speaking. Once you determine the direction of the last break, being bullish in this case, the 3 bullish scenarios to consider are these. The first is up, then up, meaning up right away. This scenario serves to catch complacent traders off guard that always look and wait for a pullback. Second scenario is decided by market makers after the initial spurt here, when there's a lot of late bulls that entered up here and a shakeout to under these lows carry a good amount of liquidity. The third scenario is decided by the market maker if there's already early bulls in this trade and their stop losses are under these lows right here. Lastly, if the books are extremely overweight to the bullish side, the market maker could decide that there's no more traders to enter on higher prices and that a reversal here is warranted. So as you might have deduced from this, that the scenarios for how a market will move is a dynamic process that is constantly being decided by the market maker based on the supply and demand. I put out a video at this point right here saying why it's not yet conclusive to long this instrument because of the middle time frames that are still bearish, and price should first pass this point, the green line right here, which was the trend origin point to the long side on the mid time frames, for this to start shifting green. At this point here, the small time frames were green, but as we said, the mid time frames were still ruby red to gray. So the way I set up my sheet is to get an overview of what 3 time frame structures are doing at the same time. This is what a trader does when he's flipping frantically between time frames to form an image. Another way to do that would be to have 3 screens in front of you with the different time frames. But even then, you can only, in reality, technically, only look at one chart at a time. There is no human alive that can look at 2 charts at the same moment to make a trading decision. So the only other way to view time frames simultaneously would have to be an indicator. And those don't have to be complicated. A simple one right here tracks structure breaks on 3 different time frames to locate a fractal trend. Namely, we want it all to be green, simply enough. I spoke about those in previous videos extensively, and will most likely be speaking about it in future videos as well. The last principle speaks to the power of waiting to recognize this moment, namely the moment when one scenario morphs into another, namely when one becomes less probable and the other becomes more probable. We don't have to guess that moment. We also use the current trend structure to predict direction. For example, in this scenario right here, after the last break was this, simple pullback to test the last break and go. So this scenario holds strong. There's no moment of shifting probability. But if we were up here, the last break was this, but we had a break right here. Now that opens up the potential and the probability for scenario number B, up, down, then up, to play out. And at this point right here will be the moment where this scenario crystallizes or becomes more of a reality. Now if we at this point get a break of this and then another break, but then we start getting a bullish break here, then 1, 2, 3, that would be the moment where the probability shifts immensely to the down then up scenario rather than the down then down scenario. And that is because we had a let's see, so this last break, or the last break in this market was this break right here, which has come from here. So the difference between the down then up scenario to the down then down scenario would be this point right here. So the moment when probability shifts between the down then up scenario to the down then down scenario would be 1, 2, 3, trend origin point to the short side, break, it's done. It's this scenario that is in play, not the down then up scenario. But if we get a hold or simply just only one break above or under this level, and then a trend or structure break to the upside where a trend origin point is formed at the third structure break, then that would be the moment where probability shifts to the down then up scenario. So thanks everyone for tuning in. I'll be putting out more videos about this subject, so make sure to subscribe and stay tuned. Cheers.